On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day, team. That's another week down. Let's run through some of the key developments that we saw. Then let's turn our attention to what we need to keep an eye on in the week ahead. Share markets first, and it was another good week for US investors. The S&P 500 index rose 1.5%, so it hit new highs during the week. We saw a slightly softer than expected inflation report that was taken well by the market. We also had some weaker retail sales figures, and they added to hopes that the US economy is slowing enough to keep the Federal Reserve satisfied. European shares were up 0.4%, Japanese markets gained 0.6%, and the Aussie market rose 0.8%. Emerging market shares were stronger still. Emerging markets were up 2.6% last week, buoyed by fresh policy stimulus out of China. We saw the Chinese government announce its most significant moves yet to try and support the beleaguered property market. So there were a string of measures, including lower mortgage down payments and central bank funding to help government-backed firms buy some of the excess inventory that developers are holding, and the plan is to convert some of those properties into affordable housing. So we saw China's CSI 300 index close at an 8-month high on Friday, and it has rebounded quite nicely over the past 3 or 4 months, having had a very tough period, 3 years of poor returns. Last year was a bad year, and the 2 years before that, so a bit of positivity in China. The local NZX 50 had a tough week. It was down 0.5%. It was dragged lower by market heavyweight Fletcher Building, which announced some pretty disappointing earnings guidance, and Fletcher Building saw its share price fall 17.1%, and it's actually trading now at the lowest levels we've seen in more than 2 decades. So the local market's still suffering from some of these companies that are providing earnings guidance or earnings updates, and many of those have been quite disappointing. So last week it was Fletcher's. The previous week I think we saw similar announcements from the likes of the Warehouse, Tourism Holdings, Spark, Air New Zealand in recent times as well. So the New Zealand market has been under pressure with some of these high-profile companies, admittedly in the more cyclical space. Some of those companies are much more economically sensitive than most. You haven't seen any negative earnings releases from the electricity companies and so forth, but some of those more economically sensitive ones definitely suffering under the weight of a slowing economy. And last week it was poor old Fletcher's, so the market was down here. Interest rates continued to fall. We had the US 10-year Treasury yield finishing at 4.42% last week. A week before that, it was at 4.5%, so it's off about 8 basis points over the course of last week. The New Zealand 5-year swap rate fell 10 basis points, so that's 0.1%. So it ended the week at about 4.9%. It was about 5 a week earlier. So interest rates just continuing to slip a little bit on the back of some of that news flow around inflation, maybe moderating a little bit, and with some softer economic indicators as well. Right, let's run through some of the key releases, and the big one last week was US inflation, and this was for April, and we got some good news for once. After 3 months where inflation figures were higher than the market was expecting, in April the inflation figures were a bit lower than the market was expecting. So that was good news, and it was taken well. The differences weren't significant. The headline CPI rose 0.3% during the month. That's the lowest in 3 months, and it was below forecasts for 0.4. So not a massive difference there. The core CPI, which excludes energy and food, increased 0.3% for the month, so that was in line with expectations. When you look at the annual inflation rates, headline inflation slowed from 3.5% to 3.4%, and the core CPI declined from 3.8% to 3.6% in terms of the annual rate of change. So for the core CPI, that's the lowest we've seen in about 3 years, which is good news. For the headline CPI, we're still oscillating in those low to mid threes, but at least things aren't getting too much worse. We're just sort of stuck in that sort of 3 to 3.5% zone. So could have been worse, and markets responded positively. You saw the US share market rise, you saw interest rates fall in the United States, and that sort of flowed through to other markets, including New Zealand. And you saw the US dollar fall. And the reason the US dollar fell is if you've got a lower inflation track, then at some point you might see the Federal Reserve in a position to reduce interest rates, and that flows through to a slightly weaker currency. And obviously the US dollar has been very strong of late, so what that means is that because of that positioning, where everyone is owning the US dollar and is flocked to it, you get any news that is slightly different to expectations and you can see quite a big reaction. So the Kiwi dollar actually rose by almost 2% over the course of the week against the US dollar. We finished the week at 61 and a half, and I don't know where we were sort of a week before that, but it wasn't so long ago where we were down in the 50s. So we've rebounded almost 2% just over the last 7 days, and that's been more about that news that we've seen coming out of the US than it has about what we've seen here in New Zealand. But we did get some releases in New Zealand that were worth watching. For a start, we had the Reserve Bank Survey of Expectations. So this is something they do quarterly. It's based on the responses from 30 to 40 business leaders, professional forecasters. The bank asks all of those people what they see on the horizon, and that is a useful way for the Reserve Bank to monitor how inflation expectations and expectations for other things, but mainly inflation expectations, how those are developing. And it's not a survey that is hugely influential. I think in days gone by, years gone by, the Reserve Bank has probably relied on this survey more, and it's been a bigger part of its decision making. These days it's important, but it's arguably not as important as it has been in the past. But there were still some encouraging signs nonetheless. The average 1 year forward inflation expectation fell from 3.2 to 2.7. Looking ahead 2 years forward, we saw expectations fall from 2.5 to 2.3, so that's quite good. 2.5 to 2.3, that's the lowest since September 2021, and it's starting to get close to that midpoint of the Reserve Bank's target range. Longer term inflation expectations weren't changed a whole lot. Looking ahead 5 years, they're sitting at about 2.2, 2.3, 10 years about 2.2, so not a lot of change there, but they're already near that midpoint. The target band is 1 to 3%, so that's sort of the zone that the Reserve Bank is wanting to keep future inflation within. They're obviously outside it at the moment, but that's where they want it to be. 1 to 3 and 2% is sort of that magic number. That's that midpoint, and we're not far off those levels, and things are moving in the right direction. So I think the Reserve Bank will be quite comforted by what it saw in that survey. We had some housing market figures too from the Real Estate Institute, and these covered the month of April, and to be honest, they were pretty sluggish. They did reflect quite a difficult and mixed housing market. We've definitely seen a loss of momentum over the last 2 or 3 months compared to where we were at late last year. There was a bit of optimism late last year, and it sort of petered out over the last 3 or 4 months. So nationwide sales volumes fell 17% from the previous month. The days to sell is sitting at 44 in Auckland and 41 elsewhere. That's not terrible, but it's not great either. The days to sell is kind of a reflection of how strong a market is. The average days to sell, when it's high, it means homes are sitting on the market for longer. When it's low, it means they're selling more quickly. So that sort of reflects market conditions, and it can also reflect when there is a big disparity between what sellers are expecting and what buyers are willing to pay. So it often tells you that there's a bit of a gap there, and it can be quite a good indicator for where prices are going in the future. In terms of prices, we saw national prices fall during April, 0.8% for the month. Auckland prices fell more significantly. And we have seen things drift back in recent months. So if you cast your mind back to the very peak of the housing market, which was late 2021, November 2021, between then and May of last year, so that's about 18 months, we saw prices fall not quite 20%, it was about 18%, but they did stabilise around the middle of last year, and we saw a bit of a rebound. And that seems to have waned. These last 2 months, we've seen prices decline, and over the last 6 months, they've been quite up and down, but the trend has been one of prices falling back a little bit. And I think that's just on the back of high mortgage rates, rising unemployment, and an economy that is in quite a difficult position. So those were the key releases that we saw last week. And in terms of what is coming up, flash PMIs for May will be out this week. And for me, these will be the most important economic releases. PMI stands for Purchasing Managers Index, and these are essentially activity indicators. But what makes them so useful is we get them very, very quickly. They're very timely. So these will cover the month of May. We're obviously about halfway through May, so they're very, very current, not as out of date as some of the economic releases that you get well after the event. These will tell us what's happening in the here and now. The Australian PMI will be out on Wednesday morning, 11 o'clock New Zealand time. The Japanese release will follow the next day, just after lunch. That's on Thursday. And then we'll get the flash PMIs for the UK, Europe, and the US overnight on Thursday evening. So for the most part, we'll get these on Thursday, and they will give us a nice updated view about how the economy is tracking in all of those places, some inflation indicators, some insights into supply chain issues or anything else that is happening out there that businesses are thinking about or worrying about. Cast our mind back to a month ago, and these indicators did all point to an ongoing economic expansion. We saw all of the major regions in expansionary territory, and when you look at the global PMI, which puts all of them together, that actually increased again, and it's sitting at the highest we've seen in 10 months, and we've now had 15 consecutive months where that global PMI has been above the break-even 50 level. And at the moment, all of those major regions that I mentioned, the UK, the US, Europe, Japan, Australia, and China as well, although China won't release any PMIs this week, that will be next week, but all of those regions are sitting in expansionary territory, which means above the 50 break-even level and growing rather than shrinking. So that will be very useful late in the week. That's the key release on the international front, although we will have a couple of other bits and pieces. We'll have the minutes from the most recent Federal Reserve meeting. That will be interesting. We'll have the minutes from the most recent Reserve Bank of Australia meeting. They'll be released too, and that will be interesting because we know that the RBA did talk about the possibility of raising interest rates at that meeting. My suspicion is that that discussion was quite a short one, and that they aren't likely to do that, or it's a very low chance of them doing that, but they did talk about it, which is interesting in itself. So we'll be watching the minutes from those two meetings. We've also got inflation releases in the UK and in Japan, and that sort of rounds out what we'll be looking for from out there in the world. Here in New Zealand, it will be all about the Reserve Bank. We have got the latest Reserve Bank OCR decision on Wednesday afternoon, 2 o'clock, and it will also be a monetary policy statement meeting. So that means that at 2 o'clock you'll get the decision itself, which this time I strongly suspect will be no change to the OCR. It is still at 5.5%, where it's been since May of last year. But more importantly, you will get an updated set of forecasts and a big report that talks a lot about everything the Reserve Bank is thinking about, worried about, encouraged by, and so on and so on. So that monetary policy statement will be released at the same time at 2 o'clock. and then you'll have a press conference from the Reserve Bank team led by Governor Adrian Orr, and I think that's usually at 3 o'clock, isn't it? So this will be very interesting. We last saw a monetary policy statement back in February, and at that time the Reserve Bank did just pare back its forecast OCR track slightly. Not a lot, but it pared it back slightly. And the first cut was penciled in for around the middle of 2025. Now, since then, we've seen inflation fall a little bit further, although non-tradables inflation, domestic inflation has been quite high, higher than expected. But we've seen headline inflation fall further. We've seen unemployment rise more than people expected. And we've seen a lot of evidence that points to a sharper than expected slowdown in economic activity. So we will be watching for any change in the OCR track. Does the Reserve Bank still see it on hold for as long as it did before? Have they changed their thinking about when they might reduce it? And we'll be looking for any clarity around how they see the economy and the inflationary backdrop. So this will be a really interesting one, and it does definitely have the potential to influence interest rates, the New Zealand dollar and the share market. Current market pricing suggests we'll see 2 OCR cuts in 2024 from the Reserve Bank. August is seen as the first opportunity for them to potentially move. That's viewed as about a 50-50 chance. If they don't do it in August, then October is when the market thinks there's a good chance of an OCR cut, and that's priced into the tune of about 96%. So those expectations will change depending on what the Reserve Bank says this week. If they continue with the tough talk and they say no, it's still a 2025 story, so don't get excited. You could see markets pare back some of those odds, some of those bets, but at the moment financial markets see the Reserve Bank as being likely to cut interest rates much earlier than the bank itself has been suggesting. And I guess that is because markets have the luxury of changing their view whenever new information comes to light, whereas the Reserve Bank only meets periodically, and it doesn't change its forecast every day or every week in response to new data. It only does it on that sort of predetermined schedule. So we'll see what they think, and there's probably a good chance that they will still have differing views anyway, even if the Reserve Bank comes out and says, look, no change is likely until 2025. I've got a feeling that financial markets will still not really believe them, and that you'll still see pricing that does reflect a potential move later this year. But it'll be interesting nonetheless. We've also got a dairy auction on Wednesday morning, so this will be the same day as the Reserve Bank, but obviously a lot earlier. We'll get that first thing in the morning. We're not far away from Fonterra providing a business update for the third quarter. I think that comes next week, May 29th, and that should be when they give us an opening forecast for the upcoming season, the 2024-2025 season. So at the moment, the midpoint of their payout range for the season that's about to end is $7.80. And most of the banks expect that to be increased to somewhere in the 8th. So that's something we'll be watching next week as well. But for now, it will just be the latest auction results that will tell us what is happening with global prices. Also quite a bit on the corporate front, both here and offshore. On the local front, we've got lots of companies announcing results and a few holding AGMs. So this week, we will get earnings releases from the likes of Gentrack, Infratil, Turners, Napier Port, My Food Bag, Oceania Health. So lots of different sectors there and lots of things for investors to watch. Vista Group is holding an AGM. Restaurant Brands is holding an AGM. Next week, you'll see more companies release results too, and I think you've got a couple of the real heavyweights, Main Freight and Fisher & Paykel Healthcare, if I'm not mistaken, are next week. So things will heat up on the local market over the next couple of weeks, and let's hope we see some good results amongst that group to offset what we've seen from the Fletcher Buildings and some of the others over the last couple of weeks. Not just here in New Zealand, that will get some really big results. In particular, markets will be watching NVIDIA on Wednesday. So this will be in the US, and it'll be overnight on Wednesday, probably into Thursday. I forget if NVIDIA usually reports while the market is open or pre-market or after the close, but be sometime on Thursday our time. And it's been such a dominant part of the US market over the last year or two. It was up almost 240% last year in terms of its share price gain. This year it's up another 87%. We're only sort of 5 months in, and it's almost doubled. And a lot of those gains have been driven by growth and underlying earnings. It's obviously a key beneficiary from the AI themes with data centers and sort of chips and so forth, and demand for more and more powerful chips to drive all of those AI related services. So it has been the market darling, sort of the unofficial leader of the Magnificent Seven. So it's been a great place to be, and it's been a very high profile stock over these last couple of years. And because of that, all eyes will be on NVIDIA on Wednesday. All right, that's all, team. Enjoy your week, and we will talk again soon.
For more insights, visit craigsip.com.